Hello guys, in this video we will take a look at what happens to $100 in 25 years if your amount is to compound at two different rates, that is at 8% and at 15%. So these are two numbers that we can essentially use to compare between what you can get out of a bank investment versus a proper stock market or an equity investment. Okay, so let's say if you had $100 in your hand and now you have two options in front of you. Okay, you can either put it in a place where you can get 8% returns every year. Okay, so usually if you look at FDs or bank accounts, in bank accounts you hardly hit 8% nowadays. It's 6%, 5% and all. So let's say there is a more risk-free place like fixed deposit or something where you can actually get 8% return and you have $100 in your hand. So what happens year on year if you put it on such a fixed deposit? So this is what this graph shows. In the year 1 you have deposited $100. So year 2 it becomes $108. Similarly, by 10th year your investment doubles. So let's say you invested a money in 2025 and by 2035 the $100 that you have invested has automatically become $200 without doing anything at all from your side. Okay, that's almost doubling. Now what happens in 20 years? So we would again think that it will double from 200, but no, that's the impact of compounding. It became more than double. Now it's $432. Okay, so what started as $100 after 20 years now became $432. If you have put it at an FD, that gave 8% returns. Now what happens at the end of 25 years? You would have received $634. So essentially the $100 that you invested after 25 years would become $634 without doing anything from your side. Now this may not sound crazy, right? This might be like, okay, that is not much of an amount, $100 to $600. Nah, I'm not interested. That's what you would be feeling. Now let's take a look at what would have happened if the returns were at 15%. Okay, so if the returns were at 15%, which means at the end of 1 year, 100 would become 115 rupees. Similarly, if you were to go by that pattern, 100 rupees at the end of 10 years would become $352. Okay, so that is a shift from 100 to 352. That's almost a 3.5 times jump in just 10 years. Now what happens after 20 years? The $100 that you have invested would have become 1,423, almost a 14 times jump. And at the end of 25 years, it would have become $2,800. So if you are able to put it on an equity or a stock or any other asset that gives excellent returns of 15% year over year, your $100 today after 25 years would become $2,800 without doing anything. Now what does this tell us? Okay, so I know $100 is too small an amount, but where the actual practical application comes into being is that, let's say you were able to save $100,000. Okay, you have 100K with you. Now you will essentially have two options in front of you. You can either take the safe route where you can just put it into an FD or a bank account where you will get a reasonable amount of returns. Okay, if you were to do that, if you were to put $100,000 at 8% returns, then after 25 years, let's say you did it when you were 30, you are at 30 age. Okay, and when you're 55, when you're about to retire, that $100,000 would become $634. Now, yeah, it's a good amount, but nah, it's not that good an amount. Okay, I mean, obviously it's a great amount, but on the other hand, if you were to put that $100,000, if you are able to find an excellent investment, okay, an excellent stock or an excellent equity, where you were able to grab 15% year on year chance. Now that is like a humongous task. Okay, finding such a good stock or getting 15% year on year return is not that easy. It's quite difficult. But let's say you were able to identify those good equities, and if you're able to identify those good investment, it might not be just equities. Okay, it could be commodities, it could be whatever you want. Okay, If you are able to identify such a great asset and if you are able to invest in it and stay invested for 25 years, the $100,000 that you invested will become $2.8 million at the end of 25 years. So how awesome is that? Okay, $100,000 becoming $2.8 million. Now at the age of 55, you have $2.8 million in your hand, and that's a reasonably good amount to retire. So that is what this tells. So what you have to look at is that rather than going for safe investments, obviously it's a safe investment. What you should do is that be strategic, identify investments that can give you a much better year-on-year return. Okay, the reality is that if even a 1% increase in the year-on-year return can have a humongous impact in compounding in terms of long term. Okay, so be strategic, find assets that can give you a great year-on-year return and invest on those, and stay invested for a long term. Thank you.